Welcome to XM.com for today's daily market comment by Mario Sajikiriakos. I'm Christina Marujos. The U.S. employment report for October was pretty solid. Nonfarm payrolls overcame forecasts. The previous month's number was revised higher. The unemployment rate fell another 2 ticks to reach 4.6%, and wage growth accelerated. Yet investors were not impressed. Treasury yields fell in the aftermath, taking the shine off the U.S. dollar as expectations for swift Fed rate hikes were priced out. There's also some extrapolating from foreign economies at play. The Bank of England got cold feet last week and didn't raise interest rates, putting investors on alert for a similar disappointment by the Fed when the time comes. Central banks will tread cautiously, so any data set that isn't absolutely stellar isn't enough to reawaken rate hike fears. This playbook will be put to the test on Wednesday when the latest edition of U.S. inflation is released. Inflationary pressures are expected to have intensified further, with the market PMIs even hinting at an upside surprise. That might just be enough to set off another cascade of worries around faster Fed rate hikes and reignite the dollar's rally. Stock markets have gone into overdrive in recent weeks. The S&P 500 closed at yet another record on Friday, drawing fuel from the retreat in Treasury yields. The issue is that this entire market is starting to resemble one colossal momentum trade, empowered by a whirlwind in the options arena. A cheerful earnings season has seen volume in bullish options go through the roof, with momentum-chasing strategies and forced dealer delta hedging adding fuel to the rally. This is an incredibly unstable dynamic that can work the same magic on the way down if market sentiment turns around. There are still several threats on the radar, and with markets so tremendously overextended, it wouldn't take much to spark a correction. In the FX market, the British pound and the Japanese yen have been the only notable movers, with sterling still feeling the blues after the Bank of England's change of heart and the yen capitalizing on the pullback in foreign bond yields. The pullback in yields also breathed life back into gold prices, which hit a 2-month high on Friday. Bullion has essentially turned into a trade on how quickly the Fed will pull the rate hike trigger, benefiting every time normalization expectations are pushed back and suffering each time they are brought forward. This was today's daily market comment here at XM.com. Have a great week.